Good morning and a warm welcome to our monthly house view. Inflation, central banks and the geopolitical environment continue to blow hot and cold on financial markets. Investors are now expecting just one rate cut by the Federal Reserve this year, following the rise in US inflation in the first quarter. The high for longer scenario, which would see interest rates remain high for an extended period of time, is gaining strength. What impact does this scenario have on our asset allocation? Market performance since the start of the year shows that this macroeconomic context remained more favorable to equities than to bonds. The first quarter earnings season indicates that corporate profits remain solid, underpinned by the strength of nominal economic growth in the US and in Europe. It is important to note that high interest rates in the US and in the rest of the world also reflect strong economic growth, and that current inflation is mainly the result of demand-side pressures rather than the supply-side pressures seen after the COVID crisis. This macroeconomic environment is therefore positive for risk assets. The greatest threats to financial markets in the short term would come from a deterioration in investor sentiment, which will lead to an increase in risk premia and a fall in price-earnings ratios. Bond markets remain under pressure, but they maintain their diversification status due to the negative correlation between government bonds and equity markets. In the medium term, we also continue to expect inflation and bond yields to fall. Finally, the longer interest rates remain at high levels, the greater the likelihood of a hard landing scenario, which would be negative for equity markets. But this is not our baseline scenario. Thank you for tuning in, and I hope to see you next time.